Hey traders, Stephen Kowitzel here with thetradersplan.com. It is Thursday, August the 30th, almost the end of the month. Market's a little wobbly today. We're going to do something a little bit different today. We're going to do a webinar on my worst picks of the year, or my worst trades of the year. I started this a couple years ago, and this is probably the webinar of the year I got the best feedback on. So my goal of this webinar is to really analyze the mistakes that I made, and hopefully you can learn from them, and we can put some rules in place to make sure that the mistakes I make, you don't make, and make sure that this doesn't happen to you, the same thing that happens to me. So we're going to go through and we're going to analyze some charts. Now, kind of a quick background about that. We're going to look at the market very, very briefly. And then we're going to go directly into about 10 charts. We're going to analyze them. We're going to see what went right, what went wrong. And just a little background about me. My worst trades of the year were not trades that I even took. They were trades that I passed on when I should have took, and I froze for whatever reason. So I'm typically a pretty conservative guy. So when I take a trade, most of the time it's right. It just doesn't work. It just doesn't work out, and there's nothing I could have done differently. And I look at it and say, well, you know, they don't all work out. Today, the 10 trades we're going to look at are the ones that I decided not to took, because nothing is more painful to me, this is my personality, than missing a big winner, because I have no problem taking a small loss, because I might, don't like to lose more than 5, 6, 7% on a trade. That doesn't hurt my feelings. But when I watch a stock go up 30% that I knew I should have been in, that hurts my feelings. So that's what we're going to go through today. Because we're going through a lot of individual charts, let's just read the disclosure real quick to make the lawyer happy. Okay, one more announcement. With the way that emails are changing, I'm starting to post more regularly on my Facebook page. If you're noticing some of my emails are getting in your spam, this is another way to check them. A lot of times I'm posting my emails in here, so you can just go to Facebook the Traders Plan, like it, and then that'll end up in your news feed. So if you're getting emails regularly, you don't have to, but if sometimes you miss them or you like them in other places, that's good. So let's go directly into the market, because that's what we're going to look at first, and then we're going to go analyze individual charts. The NASDAQ, or the market as a whole, is kind of wobbly today. The NYSE is down quite a bit. Well, I wouldn't say quite a bit, 0.64%. That's not a big deal. I kind of want to investigate that a little bit, because you can see right here that it's been zigzagging higher, kind of like the S&P 500 is, but is now maybe pulling back a little bit. But I'm more interested in the NASDAQ, because the NASDAQ has been the strongest, and it's pretty bullish. Last week, I think we were right here, and I said, it probably could have a blow-off top where it, goes up nicely, and then before it pulls back again. And that's a lot of times what happens. You can see you had it right here, and you can't see over here, but the NASDAQ is very bullish. It is reversing today, but volume isn't swelling. So, you're in a bull market. You're in a major uptrend. Yes, we're entering the worst month of the year, but you have to assume bullish outcomes when you're in a bull market and you're in an uptrend. So, because you can see most of these pullbacks, even though this gap down was scary, this bar right here probably didn't look too good, but they found support, and this one found support and, took off. So you have to assume that maybe somewhere in the zone of 7,900, maybe down to 7,800, that this could find support again, and that's more of an opportunity as a threat. Now, if it starts to undercut some of these swing low points, then, you definitely want to take more caution. But right now, I would just more look for a pullback into the 78 to 7,900 zone. It is a zone. It's not a perfect setup, because the NASDAQ is thousands of stocks. It's not one stock. The NASDAQ, at least this morning, was about 5% above the 50-day moving average. Once the indice gets about 5 to 6% above the 50-day moving average, just going back and looking at my charts, that's kind of a frothy level. So that's typically not a place where you want to back up the truck and buy a ton of stock. You sometimes want to be patient and let it come to you. And trust me, I know it's not always fun watching the market go up a few points without you, but typically this is a place where it might ease a little bit. So patience is a virtue. But right now, everything is bullish in the NASDAQ. We just got a reversal today. I'd expect it to settle down into a zone. But if it finds support at the 20-day moving average, I mean, again, we're in a bull market, so expect bullish outcomes. So that's really all I wanted to cover. It's a lot easier to cover the indices when they're in a nice boring uptrend. I want to look at some individual stocks. I have a list of stocks that I have. I'll just kind of pull it over here. I have a list of stocks that you can see that I have passed on. And these are stocks that for whatever reason, and I know the reasons looking at it, but I'm going to share with you. These are what I consider my worst trades of the year because I knew I should be buying and I didn't buy for whatever reason, and I watched it take off without me. So we're going to go through these charts today. We're going to see what went wrong. I'm just going to totally just tell on myself, really. And I know that's a little bit different because most publishers like to cherry pick and show their best trades. But you don't learn anything from that way. You got to analyze your losers or your bad trades too. So we're going to go through these today. Let's start with SECO. Now this is a Chinese stock. I had pinned it right here. You can see that the stock has been in a downtrend, right? And I've been keeping my eye on it because the fundamentals were great, and Chinese stocks can move very, very quickly. These are Chinese ADRs listed on the NASDAQ. And so I was just waiting for what I call the no news volume pop. And it happened right here. So you have this huge, let me get this inspect button off. This was on July 9th. So you have this huge volume bar right here, and it is hugging the long-term moving average, the 50-day. A lot of times what I'll notice is sometimes when you don't want a stock to live under the long-term moving average, but when it starts to hug it just under it and keeps trying to get through it, a lot of times eventually it'll go through it. So, but I passed on it because this was a big bar. I mean, I was going to have to risk over 10% to find out if this trade worked. And I don't like to risk that much. I could have just taken a half a position. That way I would have only risked technically 5% and just put a stop loss under this bar. But I was eyeing it and I looked at it, and what I said is I should put a buy stop order above this level. Now, you're going to hear this over and over again, and it's something that I'm really trying to force myself to do. A buy-stop order is when a stock is very close to a level and of breaking out. And it doesn't have to be a traditional breakout zone. It's very close to a level, and you think it's going to break out, but it's going to be a fast-moving stock if it does. That way, as soon as it crosses a certain point, it'll automatically purchase. Now, this serves multiple positive things in your trading skills. One, you don't have to stare at the screen. If it breaks through, it breaks through. Two, it keeps you from freezing. It forces you, buys the stock without you having to push the button. Because sometimes when you're dealing with volatile names, at least me, I tend to freeze up, or I say, I'll find a reason not to do it. So I didn't do it. And naturally, this stock went from about 10, what price should I have bought it at? About $10 approximately, all the way up to $15.48. So that's a 50% gain. What I should have done is just about 1% or a half a percent above this day's candle right here, place a buy stop order. That way, if the next day it breaks through, it automatically buys me in. If the next day it rolls over, I don't buy anything. Now, I would not have made the whole 50%. Let's get real. I wouldn't have sat through that. I probably would have sold half at 10%, raised the stop to break even, and, maybe I would have taken some profits somewhere in here or around here. But it was a nice potential trade that I passed on because it was a volatile name, and I did not put my buy stop order, and then the next thing I know that it's gone. Another reason why I passed on this trade is you can see up here, this is the S&P 500. Let's look at this right here. you can see that S&P 500 was in a pullback. I have a hard time buying in pullbacks. It's just me. I do sometimes. I'm not a big fan of buying pullbacks. I don't like buying traditional breakouts, but I like to make sure the environment is right. I'm not always trying to be the earliest, at least with swing trades. So looking back, this would have been a really big winner if I would have put a buy stop order in it, and it would have forced me in. I also could have, if I'm afraid of the volatility, you can always take a half a position. That way, if you make some money, you feel good, but you're definitely going to feel bad. And believe me, I felt almost sick when I had the stock right, but I didn't act, and it ended up going up 50%. Again, I wouldn't have made all that. I would have taken profits on the way up. But lesson learned, buy stop orders. There was a lesson that I heard, I think, from Arthur Hill, who heard it from somebody else. And this trader had this sign on his computer screen, little sticky note that says, just close your eyes and press the button. And I always laugh, and basically what that means is you're fearful of the trade, but you need to press it anyways, because a lot of times when something doesn't feel right, that's typically the best time to go in it. So let's look at the next trade, Zito. Now, we did take one weekly reversal trade on this that didn't work out, but I want to look at the one where I did decide to pass on. And Zito Express, and that is, it's really ugly right now, but I would have made money on this trade. You can see that it made a bullish move all the way up from 14 to 21. That's a 50% move. And then came down and touched the 50-day moving average twice. I was really paying attention when this happened. This was around the same time, as you can look, as SECO. Right there should have been the entry, but I don't remember. Maybe I bought something else. I decided to pass on it. I typically don't like to load up on trades all at once. I kind of try to ladder in and ladder out. But what I could have done is just buy right at support, put a stop right under it. If it breaks, so be it. And on this one, this probably would have been only a 5% gain, because what I would have done is I would have sold half at 10%, 8 to 10%, raised the stop to break even, and sold the remaining once it broke even. So I would have netted 5%. So probably would have sold somewhere around here. So it wouldn't have been a big winner, but it's more of the principle of, knowing when you should be buying stock, or when a signal happens, you need to just buck up and press the button. So I should have taken this trade, and I didn't. I ended up taking it when it reversed here, and then the market pulled back, and the volatility, it didn't work out. So again, when you find that entry, that bar that you feel it shouldn't go under, you buy that bar and place a 0.5% to 1% stop under it, take profits on the way up, ride with a little bit of house money. What's the next one? INSP. This one drives me nuts. And again, remember, these are stocks that I did not trade. Now, okay, INSP, Inspire Medical Systems. So, and this is, I'm currently working with a professional research analyst to really study certain patterns and back test them. I've noticed this pattern over and over again, and it's very common among IPOs, or IPOs less than 1 year. And, it's the high handler, what I call the shakeout. And typically what happens, and I have the 20-day moving average plotted on here. Typically what happens is, if I were to annotate this, draw a box, a stock will go up, it'll create kind of a deep cut, and it'll go straight up from the bottom, and it'll try to break out. Well, typically, this is the area where the market makers are selling and the weak holders like you and me, the retail investors, are buying. So what happens is the strong hands exchange to the weak hands. The weak hands get shaken out under the pivot. So it tries to break out, it fails, and it pulls back under the pivot, touches this 20-day moving average. That is the typical support. That is the typical entry. So one could call a very high cup with handle. I don't really like to call it that because just of the way the depth of the pattern is what I'm finding, and I'm finding this is very common in IPOs because a lot of times IPOs are fairly new stocks. They're trying to find their identity or their personality. What kind of stock, what kind of personality is the stock going to have? Is it going to be, wide and loose? Is it going to be tight trading? So this right here, when it failed, you can see when it failed and pulled back under the pivot, this 20-day is coming up under it to find support. That bar should have been the entry, and I don't know how much of this gain I would have taken, but I know I would have taken at least half at 10%, raise the stock to break even, and then make a determination of how much longer I want to hold it. Here's the interesting thing. This was at 32, so let's say I would have got in around 34.88, I think is the high of that day. I just assumed I got the worst price of the day. It's at 53.59 currently, and it hasn't even broke the 50 or the 20-day moving average. That is an incredibly strong trend right there coming out of an IPO. I really like looking at IPO charts. Every single week I look at the new inventory that comes on the market. I look at their sales. I look at their earnings. A lot of biotechs that don't really have earning potential, or those small caps. But the point is, the pattern, I should have taken it, but it was right here when the market was looking like it was going to correct, which it did. But this didn't really correct that much. You can see when the market's going down, this thing's going up. And some of the strongest stocks, they will buck the trend. Sometimes I have a bad habit of overanalyzing the overall market when I should be just, making sure that the bull market is intact, but focusing more on the individual strong stocks. So again, this was a mistake that I made. I wouldn't have sat through all this. This would have been a swing trade. But my point is, the pattern, I stared at it in the face and I decided not to take action on it. So this high handle or this shakeout, I call it buy the shakeout. And you've heard me, if you're a subscriber, you've heard me talk about over and over, this pattern usually emerges in the strongest stocks. And I see way more strength coming out of this than weakness. What's next? Curo. Now, I still own Curo, but I should own more. So let's look at this for a second. Let me go back just a little bit further on this chart. Okay, I own this stock and I'm currently up 70%. So here's what I noticed. I'll take you back. The stock was trading sideways, giving up nothing, pretty tight action when the market is just sloppy as all get out. So the relative strength line is rising. It's showing that it is bucking the trend. All I did was wait for a breakout day. This one I did play right on the initial buy. I did buy I put a buy stop order, and I got filled right at 1780, right above these levels, and I got filled at 1793. Still on half. Now, so it broke out. It did exactly what I thought it was going to do. It broke out. It was a 10% day and huge, nice volume. And so I'm sitting in way down here when most people are buying up here. But look at what happened. The market makers are selling to you, so the strong hands are exchanging the weak hands, and it tries to come back under the pivot, and that's exactly what it does. Finds support at the blue line, the 20-day moving average. The shakeout happened, and then it absolutely takes off. Now, here's where I made the mistake. I sold half on this day. I was up about 25%. The lockup period came up, and some of the board members sold their shares. So you have this dumping. But what I should have done, if I was smart, because I knew this was, because it came right back. Like it came right back. If I were smart, what I should have done is I wanted to buy as it got close to the 50-day moving average. But look at what was happening with Mr. Market. As this thing was trying to pop off of the 50-day moving average, the market was coming down. So I held off. Shouldn't have done that because, again, this is a strong stock. It can buck. I should have bought my half back. Instead, I'm still owning my half, and that's a big missed opportunity. 23. It's right now at $31 a share. I mean, that's a pretty good gain right there, 35 to 40% that I should have on half of my shares. But again, the mistake that I made was the market looked like it was rolling over, and it did break this downtrend right here, right at the time I passed. So in my head, at least I think that if it wouldn't have gone correctly, I did right, but I could have easily just place a stop under this. If it didn't work out, it didn't work out. But look at this stock as the market is rolling over, and I say rolling over 4 or 5%. This thing is surging, just doesn't give a rat's behind what the market is doing. That's a lot of power right there, and it has not broken the 50-day moving average since. So it's a steady Freddy. What I call steady Freddies are stocks that will just go up in a 45-degree angle, pretty easy hold. But I made the mistake of not buying my half back. And I should have done that because the market looked like it was rolling over. Fear. Okay, greed, fear. I'm sure you've heard of it. Stitch Fix. Let's go look at this. Okay, so you have the shakeout pattern that happens. Again, let's draw this out and really study this for a second. So, and this is what I'm talking about, and I'm about to undergo a massive market study of this pattern, where it has to go up a certain percent, failure breakout to an all-time high, and then pulls back and finds support right there at that 20-day moving average. It found support, but it was a little sloppy for me. It started to chop up, so I don't know if I could totally throw this in the mistake mode. Just because a lot of times when stocks really get sloppy, it's not my cup of tea. But I saw the pattern. And this pattern emerges from the strongest stocks, and it just absolutely took off from there. I don't know how much I would have made. I would have at least sold half at 10%, raised my stop to break even. Probably would have sold somewhere around here. So I might have made 7-8% net. But look, it's still going. Some stocks don't go straight up. You have to be willing to stomach through some of these pullbacks, and the best way to stomach the pullbacks, honestly, is to pay more attention to weekly charts, or put more emphasis on weekly charts than on the daily charts, because there's a lot of noise right here, where if we look at maybe a weekly chart, it's a little bit more, it's a little bit smoother. Yeah, let's reset that. See, that's a little bit smoother than all the sloppiness. But the point is, I saw the pattern, and since I've been starting to buy more of these patterns, I bought one the other day. We'll see if it works out or not, but I didn't want to buy it, but I bought it because I saw that pattern, I saw the strength there, so I closed my eyes and pressed the button. But again, I want you just to take notice. The market was pulling back. So two things. If we can have a rule in place, when you see this pattern emerge, this shakeout, you can place a buy order, let's just say 3%, within 3% above the 20-day moving average, because not all the time it comes right down to it. So I could have placed a buy order anywhere under 27. And if it sliced right through that and didn't find support, I would have just sold it same day. But this is a fast-moving stock. So what it could have done is it could have came down, touched the 20-day moving average early in the day, bought me some shares, and then found support. And by the end of the day, I was in the money. So again, the market was down, but I was focusing on that and not the pattern. REGN. Whoops. We can shut that. Okay, so this was a weekly reversal pattern. That ain't right. Let me get rid of some things. This is a weekly reversal pattern that I passed on. Volume below. That I just shouldn't have. And again, I'm definitely, I've done pretty well, but I think that I'm getting even better. So you have this, because try to learn from your mistakes. So you have a weekly reversal pattern right here. So you have ugly downtrend from 543 a share. This is REGN, all the way down to 281. So let's just say it got sliced in half, which it did. Reversed, okay? So, and then it started pulling back, but then it started coming back. And again, you have the long-term moving average, or the 10-week, is starting to curl the other way. It's hugging under it. I should have bought it because of three things. One, the weekly reversal pattern happened. Two, it came back and was hugging under that moving average, which typically it'll take a couple stabs, and then the second or third one it's through. And another one, you could definitely tell the momentum is slowing, because look at how steep this is, and then it'll bounce, and then it'll roll over, and then it'll bounce, and then it'll roll over. Well, it rolled over, and then it really, for about 4 or 5 weeks, just started trading sideways. The selling had exhausted. And I'm starting to pay more attention to these downtrends, and you can see it, and you don't need a MACD to tell that a lot of times when it starts to curl just a little bit, you need to pay attention if it starts to break through moving averages or if a weekly reversal has happened. So I saw the momentum slow. Maybe, I don't remember exactly why I passed on it. Maybe I already owned a lot of trades and I didn't, again, I like scale in, scale out, but this is one I should have taken. And I took Celgene and that one worked. And this was in the same category, but it just doesn't look right. Okay, Facebook. Oh, Facebook. I want to look at the daily chart. Okay, so I remember this, right? This is what I remember. I remember I missed the weekly reversal pattern. This is a daily chart, but there is a weekly reversal pattern right here that I missed. But then it gapped up, and it was right here, and it came down, and it reversed right on this 50-day moving average. And I remember I should just buy it here and place stop right under it. And if I get stopped out, it comes back down, so be it. But I didn't, okay? For whatever reason, maybe the market was pulling back. This was, again, it goes back to that first trade I showed you. If you see a chart that all of a sudden moves very quickly and then it pauses, you can place just a tiny stop under that candle, so you don't have to risk a ton. And of course, it went off like this. So I probably would have I probably would have taken 10% if I would have taken this trade. Rose my stop to break even, and I probably would have tried to hold on to it, because I think Facebook, it has its challenges, but I am I buy advertising, and there's nothing like Facebook, advertising platform out there. Like Warren Buffett talks about, he likes to buy companies that have a moat. In my opinion, Facebook has the biggest moat around it as a publisher. Now, how you feel about Facebook, I'm not getting into that, but my point is I wanted to own it long term, so I probably would have been stopped out when it gapped down from the earnings report. So I might have honestly only made 5%, because I would have sold half at 10, raised, stopped to break even, and then stopped back out at break even. So probably would have only made 5% on the trade. My point is I should have taken it. I could have done a low-risk trade right here, and I didn't do it. Goose. All right. I know exactly what I did wrong here. All right. This, I was in Disney World. Let me get the S&P price back up here. Let me get the RSI back up here. Okay. So let's look at just a little bit longer of a chart. And this is just one of those charts. I look back at it and I just want to jump through a window because I should have it. So the stock broke out right here, clear as day, fairly new stock, had great earnings. It came down and it found support right at the breakout zone, right at the 50-day moving average. We bought it. Went up, and we sold half and raised our stop to break even on the remaining shares. On this day, when it was pulling back, this 1995 day, I remember I was at Disney World. I had a stop in it, But if the stop got triggered, I was about to go back to the parks. I wasn't able to email everybody and let them know that, hey, we got stopped out. So I went ahead and sold it because it was like at 2010, something like just 1% above it. So I sold it, and it never triggered the stop, or it wouldn't have. So we went ahead and sold half here, just to get rid of it, and I wouldn't be worrying about it, and I could be, walk around with my mouse ears on. And it just, that was the low, and it just absolutely took off, just doubled from there. And it is a perfect example of when planning your trade, trading your plan, and you decide to change your plan. And I want to focus on why making trading mechanical with buy stop orders, with stops, forcing you to take the emotions out of trading. And I wouldn't say I had emotions. I just knew if we got stopped out, I wasn't going to be able to alert everybody. I was at Disney. So I sent it out when I got back to my hotel, and then I went back to the parks. But if we just would have stuck with it, I'd be sitting just fine. Again, this is just one of those trades. I probably wouldn't have sat through all of it, but that's a pretty good move right there. It's a very strong move. I continue to try to find setups that are objective. And objective means, they're very rules-based. There's not a lot of, art, and it's just the science. Well, sometimes you can get it down to a science and then reality happens. So when you have a set rule in place, whatever your rule is, when you first buy the stock, you should not change that rule unless something drastic happens. You should stick with it and give it room to run, and boy, has it ran. That was at $20. It's now at $60. I'd have never sat through this consolidation. I'd have never sat through this. So I want to be clear about that. I'm not saying I would have had a triple on my hands just because I know my personality. But I would have had more. I would have had more if I would have just done nothing. But I didn't. I did something. I messed up. Chrome. So I hope this is helpful. We got 2 more stocks we're going to go through. We are all human. And the market is just full of emotions. Okay, I want to shrink this chart a little bit. Sucker is down big today. Down 30%. Yeah. I think a class action lawsuit came out about it misrepresenting. So, yeah. This is why you don't want to chase these kinds of moves. But here's what I did. I've been talking about when this gapped up along with every weed stock out there. When that gapped up, I said, hey, this could be a catalyst for marijuana stocks, turning the corner. Never in 1,000 years will I have guessed that every marijuana stock would have tripled in 2 weeks. Like, I didn't call that. I just said maybe the trend can change. But it did. I mean, it went parabolic. I'm not mad about a parabolic move that happens rarely. What I'm mad about is I was looking at it right here on this candle as the 20-day moving average was curling up, and I said, you know what? I should buy it right here and just put a little stop under it and just see what happens. And I didn't do it because I wanted it to consolidate longer. I don't typically like to buy 1 to 2 day pauses. I like longer consolidations. Just take a breather and then take off. Well, I didn't buy it, although I could have just risked maybe 5 to 6, 7% to the downside for a potential nice winner. Now, this nice, I did not predict that. I wouldn't have known. But then it just takes off. And I think this day we had sold, or this day, our marijuana ETF as it was gapping up. We took 10% profit. And then they just kept going off. I mean, just nuts. And, it's not painful to watch it go up here, because that I know is a rarity. But, man, to hit home runs, you got to swing the bat. And it's best to, as Warren Buffett says, swing at the fat pitch. But it's okay to strike out a lot, too, if you know that you are going after potential home runs. You can strike out several times in a row on, what would considered a potential fast-moving stock, and only if you find that bar, and to me this was that bar that I said it shouldn't go back below this if it's about to turn. And I was right, but I didn't make any real money. I made a little money, not any real money. Well, anyone who chased it up here is not a happy man because it's down 30% today. So, but the point is the same thing on the Facebook stock. It gapped up, it paused, I saw it, the 20-day was curling up, I've seen it before, should have just placed a stop right under it, small trade. I would have been, at least feeling good about myself, no matter what percentage of the portfolio it was. I didn't do it. Failure. IIV. This is going to be the last one, okay? I've beaten up on myself a lot today, and I hope it was for your enjoyment. Because, again, I don't get angry when I lose, because typically my losses aren't big, and typically I have good portfolio management skills where I'm not going to have huge drawdowns in my portfolio. You gotta swing the bat. Not all of them are going to work out. If you can have 65, 70% win ratio, which I have, over a 12-month period, sometimes it's 50%, sometimes it's 90%. On average, you want to be in that 70% range, you're going to do just fine. This was a stock I should have had a buy stop order in, and I whiffed it. I did not do it, and this was a stock I sent out to everybody, so maybe you made money off it and I didn't. But hold on, here's where it gets interesting. Let me annotate this a little bit. I'm bringing this stock back to you. Check it out. What happened? What is the pattern I've been talking about? So this, I'm going to leave that up there. Okay, so let's go back. Okay, you have a gap up in earnings that came back, but then it started coming back and it started curling up and it was finding support at the 20-day moving average the whole time. On this day right here, I sent an email out saying this looks like it's poised to pop. I forgot to put my buy stop order in. What I wanted to do is make sure it crossed this 1630 level, make sure it was kind of thrusting higher. I just forgot. By the end of the day, it was gone. Like it was kind of out of my range for what I wanted to risk. And that is why, in my opinion, buy stop orders are so good for fast moving stocks. If you can take away two things. Take away two things from this. One, buy stop orders are great for fast moving stocks. That way, because a lot of times by the time they break out, by the time you see them, that sucker is long gone. It's hard to buy fast moving stocks. So use buy stop orders. Two, try to find out where your fears are in the market and where your weaknesses are and write them down. I guarantee you what just popped in your head, what your weakness is. You know what your weakness is. Try to find some rules to make it, to overcome it. I think buy stop orders for me solves a lot of my problems. One, because I don't like buying markets during pullbacks, and the strongest stocks will move higher even when the market's pulling back. And two, I do like to buy the strongest stocks, and it forces me in. It keeps me from freezing. Now, I trade a lot of stocks, so I can't trade them all. All the ones I like, I can't trade. But this is just one that I whiffed. I forgot. I should have owned it here. I didn't. And I probably would have already sold half, 10%, race stop to break even, just like I like to do, and let it run. Here's where it gets interesting. Look at the pattern that has emerged again. You have this shakeout. Now, to me, hasn't really shaken out a lot. The price is at 1884. The 20-day moving average is all the way down here at 17. I like to get it within 3%, say 1750. But look at these big swings. I mean, it was 1765 yesterday. My point is, if you like a pattern like this, you find a stock, you find it's starting to shake out, you could place an order within 3% above that 20-day moving average. That way, if it breaks through, it'll automatically purchase your shares. And if it breaks through any further, breaks support, doesn't find support, you got no business in the stock. Get out, move to the sideline. But this stock is looking kind of strong, and it's looking like it might not come down. So you have to keep that in mind. Again, the best stocks are not going to give you a lot of opportunities. It's trading sideways. It's tried to punch through an all-time high. It cannot get through this 19 level, cannot close through this 19 level. I keep an eye on this one because this might thrust through. So you could place a couple orders on it. You could place a buy order at 1950. Make sure it clears these, or a buy order down here. I probably would wait for it to consolidate for a little bit longer before I place a buy or stop order up here. So I hope this was helpful. I know it's a little bit different than what you're used to. You're probably used to just people showing you their best picks, and don't get me wrong, I do that all. I'm guilty of that. But if I'm always showing you the best picks, I want you to learn with me, and I want us to learn from each other. So me sharing all my stories and the trades I took and the trades that I didn't took, and that's what the Trader's Plan is all about. Try to put those rules in place to make sure that you don't make the same mistakes again, or you don't make the same mistakes that I do. So I hope all is well. I hope you have a great weekend. Bye-bye.